Something just happened in the mining sector that has not happened in over a decade. And if you missed it, you need to understand what it means. Because this is not just a rally, this is a structural shift that is rewriting the rules of how wealth is created in the precious metals market. For years, gold and silver investors watched their physical metals soar while the companies that dig it out of the ground barely moved. The disconnect was maddening, frustrating, it made no sense. But in the last 12 months, that disconnect vanished. The miners finally woke up, and when they woke up, they did not just catch up to the spot price, they obliterated it. Let me show you the numbers. In 2025, gold delivered a staggering 65% gain. That is an extraordinary year by any measure. Gold went from around $3,000 to over $5,000. But the VanEck Gold Miners ETF, the benchmark that tracks the biggest mining companies in the world, did not just match that move. It crushed it. The GDX ETF delivered 155% returns. Let that sink in. Gold went up 65%. The miners went up 155%. That is 2.4 times leverage. For every dollar gold moved, the miners moved $2.40. This is the catch-up mode that analysts have been predicting for years, and it finally arrived. Now, let me explain why this matters for silver. Because if you think the gold miners had a good year, the silver miners had a historic one. Fresnillo, the world's largest primary silver producer, saw its share price nearly triple in 12 months, 3 times. When silver hit its peak of $64 an ounce in late 2025, Fresnillo was not just participating in the rally, it was leading it. The stock went from the bottom of the market in 2024 to becoming the top performing stock on London's FTSE 100 index in 2025. And it is still climbing. The company is sitting on record profit margins. It is generating free cash flow like a money printer. And institutional heavyweights like JP Morgan are loading up on the stock. So what changed? Why did the miners suddenly explode after years of lagging behind the metal? The answer is margin expansion. And if you do not understand this concept, you are missing the entire story. Let me break it down. Mining companies have fixed costs. It costs a certain amount of money to pull an ounce of gold or silver out of the ground. This is called the all-in sustaining cost, or AISC. That number includes labor, fuel, equipment, royalties, everything. For most gold miners, that cost sits around $2,000 to $2,150 per ounce. Now here's the magic. When the price of gold goes up, that cost does not change, it stays flat. So if gold is trading at $4,000 and your cost is $2,000, you're making $2,000 profit per ounce. But if gold jumps to $5,000 and your cost is still $2,000, you're now making $3,000 per ounce. That is a 50% increase in profit from a 25% increase in the gold price. This is operating leverage, and it is the secret weapon of mining stocks. In 2024, the miners were stuck. Inflation was ripping through the global economy. Fuel prices were high, labor costs were rising, equipment was expensive. The all-in sustaining cost for many miners climbed from $1,500 to over $2,000. At the same time, gold was rising, but not fast enough to outpace the cost increases. So even though gold was going up, the profit margins were getting squeezed. Investors looked at the mining stocks and said, why would I buy this? The metal is going up, but the companies are barely making money. The stocks lagged. The frustration built. But then something shifted in 2025. Costs stabilized. Inflation cooled slightly. Fuel prices came down. Labor markets balanced out. The AISC stopped rising. And suddenly, with gold at $5,000 and costs holding at $2,150, the profit margin exploded. Miners went from making thin margins to printing money. Free cash flow went vertical, and the stocks followed. Now, let me show you what this means in real numbers. Imagine a mining company that produces 1 million ounces of gold per year. In 2024, with gold at $4,000 and costs at $2,000, they made $2 billion in gross profit. Not bad, but in 2025, with gold at $5,000 and costs still at $2,000, they made $3 billion. That is a 50% increase in profit. But here is where it gets wild. That extra $1 billion does not get eaten by costs. It is pure margin. It flows straight to the bottom line. It goes into dividends, share buybacks, debt reduction, expansion projects, and the stock price reflects that. This is why the GDX went up 155%, while gold only went up 65%. The leverage is real. And for silver, the story is even more explosive. Silver outperformed gold in 2025 with a 114.8% gain year to date, the biggest annual rise since 2010. But this time, the fundamentals are stronger. Solar panel production has quadrupled since 2015, from 59.6 million ounces to 232 million ounces, a 289% increase. The IEA forecasts that by 2030, solar demand alone will consume 40% of global silver production. Add in electric vehicles, 5G infrastructure, and defense applications, and you have a supply crunch that is getting worse every year. The deficit is real. For 5 consecutive years, the silver market has been in deficit. In 2024, the deficit was 148.9 million ounces. The world consumed nearly 150 million more ounces than mines produced. Stockpiles are dwindling, and the miners see this. This is why companies like Fresnillo, Hecla Mining, and First Majestic Silver are not just riding the wave, they are expanding. Fresnillo just announced the acquisition of Probe Gold, a Canadian exploration company with the Novador Gold Project. That project has the potential to produce over 200,000 ounces of gold annually for more than 10 years. The deal marks Fresnillo's entry into Canada and adds 10 million ounces of gold resources to their portfolio. This is not defensive positioning, this is aggressive growth. Hecla Mining is doing the same thing. The company is advancing its Polaris exploration project in Nevada, which has been cleared for exploration in 2026. Initial drilling at the Midas project discovered high-grade gold with visible gold on a new structure. This could position Midas as a low capital cost opportunity to expand production. Hecla is also strengthening its balance sheet, lowering debt, and focusing on the highest risk-adjusted return projects. The Zacks consensus estimate for Hecla's earnings shows year-over-year growth of 245.5% for 2025 and 8.8% for 2026. That is not a typo. 245% earnings growth, and the stock is still trading at reasonable valuations. First Majestic Silver is another standout. The company gets 57% of its revenue from silver, making it one of the purest plays in the sector. It operates 3 mines in Mexico and the Jarrett Canyon gold mine in Nevada. It also owns a 70% interest in the Los Gatos joint venture. In early 2025, First Majestic spent $970 million to acquire Gatos Silver. That was a bold move, but it paid off. The company now has a portfolio of high-grade silver assets positioned to benefit from the supply deficit and rising prices. The Zacks consensus estimate shows earnings growth of 279% for 2025 and 37% for 2026. The stock is trading at a Zacks rank of 2, which is a buy rating. But here's the thing that most investors miss. You do not need to pick the perfect stock. You can buy the entire sector through ETFs like the VanEck GDX for gold miners or the Global X Silver Miners ETF for silver. These funds give you diversified exposure to the best operators in the world. And because of the operating leverage we talked about, the ETFs deliver multiples of the spot price return. If gold goes from 5,000 to 6,000, that is a 20% move. But the GDX could deliver 40 to 50% because of the margin expansion at the underlying companies. This is how wealth is built in bull markets. You do not just own the metal, you own the companies that produce the metal, and you let the leverage work for you. Now let me address the risk. What if gold and silver crash again like they did in early February? Volatility is part of the game. In late January 2026, gold crashed from 5,600 to 4,400 in 48 hours. Silver fell from 121 to 71. The miners got hit, but the dip buyers showed up. China kept buying. Central banks kept accumulating. Within a week, gold was back above 5,000. The crash was a shakeout, not a breakdown. Christopher Forbes at CMC Markets called it a classic air pocket after an extraordinary run. The longer-term bullish thesis remains intact. Macquarie just raised their outlook. First quarter gold forecast went to 4,590, up from 4,300. Silver Q1 target jumped to 75, up from 55. Goldman Sachs targets 6,300 for gold. Bank of America calls for 6,000. If those targets hit, miners will triple the move through operating leverage. And here's the final piece that ties it all together. The sector is still underowned. Rory McPherson, the investment chief at Rand Sterling, pointed out that UK miners in particular are very underowned stocks. That creates upward pressure. When a sector is underowned and starts to perform, institutional money flows in. Pension funds, sovereign wealth funds, hedge funds. They chase performance, and that buying pressure drives the stocks even higher. We are watching a regime change in the precious metals market. For the first time in over a decade, the mining equities are behaving the way they are supposed to. They are leveraging the spot price, they are delivering multiples of the return, and they are attracting institutional capital. The VanEck GDX officially transitioned in September 2025 to track the Market Vector Global Gold Miners Index. This move was designed to focus on free float market capitalization, giving a more accurate picture of liquidity. The index now trades at a forward price to earnings ratio of 13 to 24 times, a significant jump from the depressed levels of early 2024. That is still reasonable. It is not stretched. There is room to run. But there is another dynamic at play that is accelerating this move. We are seeing a rotation out of speculative assets and into hard asset producers. Look at what happened to Bitcoin during the same period. While gold hit 5,300 and silver broke 115, Bitcoin lagged. The digital gold narrative started to crack. Investors realized that in a real crisis, in a real supply shock, you cannot build a solar panel with Bitcoin. You cannot put Bitcoin in a missile guidance system. You need physical silver, and if you need physical silver, you want to own the companies that control the supply. This is why the capital is flowing from crypto into miners. It is a structural shift from bits to atoms, from speculation to production. And the mining companies are using this moment wisely. Instead of overextending on risky projects or chasing vanity acquisitions, they are being disciplined. They are paying down debt. They are increasing dividends. Pan American Silver just closed a $2.1 billion acquisition of Mag Silver, adding the high-grade Juanipio silver mine to their portfolio. That was a strategic move. It was not reckless. The company now has 10 producing mines across North and South America with 452 million ounces of silver reserves and 6.3 million ounces of gold. The balance sheet is rock solid. Free cash flow is strong. And management is returning capital to shareholders through dividends and buybacks. This is how you build a durable mining company. The lesson for investors is clear. Do not fight the leverage. Do not sit on the sidelines waiting for the perfect entry. The sector has already moved. The catch-up happened. But the bull market is not over. If Goldman Sachs is right and gold goes to 6,300, the miners are going to deliver outsized returns. If the supply deficit in silver continues and prices push toward 100, Fresnillo and First Majestic are going to print money. The opportunity is not in timing the bottom. The opportunity is in recognizing the structural shift and positioning accordingly. Own the metal for protection. Own the miners for wealth creation. The narrative has shifted. In 2024, investors were frustrated. They asked, why should I buy miners when the metal is easier and safer? But in 2025 and 2026, the answer became clear. You buy the miners because they give you leverage. They give you 2 to 3 times the return of the metal with the same underlying thesis. You buy the miners because they are generating free cash flow, paying dividends and buying back shares. You buy the miners because the sector was left for dead and is now roaring back to life. The catch-up is complete. The lag is over. And the next phase of this bull market belongs to the companies that dig the metal out of the ground. If you are holding physical gold and silver, you are protected. But if you want to build wealth, if you want to turn a bull market into generational returns, you need to own the miners. The leverage is real, the fundamentals are strong, and the opportunity is right in front of you.